Hello, my name is Chris, and I'm a head trader and co-founder of TradingXYZ.com. We provide real-time buy and sell signals to institutional and retail clients. Today I'm making a video on tips on building winning and profitable trading systems. I think these things can help people out in the beginning. There's some general attitudes and qualities to have before you begin. If you really want to succeed, you're going to need to have optimism, patience, knowing who you are, a lot of perseverance, hard work ethic, and discipline. Okay, let's begin with optimism. I may not be the first to tell you this, but if you've not heard it before, then here it is. Most traders do fail. This is true, and you really need to understand that the odds are stacked against you. This does not mean that you should not try or trading is impossible, but it helps to know this ahead of time. Why? Because you need to understand up front that trading for a living is a very, very difficult thing to do. Being optimistic will help you when the times get tough. Second quality to have is patience. Don't assume that success is going to come quickly at this. It usually takes a lot of time to build a successful trading system. Learn to think in terms that it may take a few years rather than days, weeks, or months. All good things in all good time. Third, you have to really know who you are before you begin building trading models. Understanding what type of personality you have will help you design trading models and systems that will suit your temperament and personality. For example, some people want a lot of action, so they should trade models that trade very frequently. Other traders may be a little bit more mellow, so they might trade models that have less trades. And the other things to think about are, how patient are you? Can you hold a position for more than a few minutes? Can you hold it for days? This too is part of the process of building a successful trading system. The point is to seriously analyze who you are and what you are like first, and then begin to trade models and build models and think about the qualities of these models. Most traders believe that they will be able to create a trading model and start making money right away. I'm not sure why most traders make this false assumption. Being a successful trader is no different than being a successful surgeon or succeeding in any other profession. It takes many years of hard work and perseverance to be successful in any profession. Okay, and the last quality is discipline. You really need a lot of discipline to be a trader. Keep things simple. That's an overlying concept that you should think about. The less variables, less indicators, or less conditions you impose on your models, the more flexible they'll be. Many traders make the mistake of adding more and more variables to their trading models, believing that it makes their models better. But the irony is that strategies that have a lot of variables, are very complex, tend to give poor trading signals, especially when the underlying market conditions change. You know, the market is like the ocean. It's constantly moving and changing. If your models are not flexible, they'll break. Keeping things simple gives these models more flexibility. It keeps them more robust, and they're better able to handle ever-changing market conditions. You need to backtest once you have models. This is so important. The way I went about it is that I started with small samples of random time periods. It's better to just take a few periods of time, randomly take them, and judge your model's performance on those random time periods. If you feel positive about what you're seeing, then it's better to start opening it up and expanding the sample sizes and the time periods that you're testing. We can talk about sample sizes. In general, the larger the sample size, the more confidence you can have in your results. One rule of thumb that's used is that a sample size should contain at least 30 observations in order to have some confidence in the results of the study. My general feeling is that 30 observations is still very small. Another concept I've come across is that it may be useful to have 30 observations for each variable in your trading model. Ultimately, you have to use your own judgment about sample sizes and testing in order to have confidence in your models. For example, even though you have a large sample size, if it's only from one time period or from 1 year, then you probably should not have too much confidence in the results you're getting. It is not only the size of the sample that matters, but it's the variety of periods it is drawn from. Basically, larger sample sizes are what you're looking for to have more confidence trading, and those samples should be coming from a variety of different periods and market conditions. Once you feel comfortable with your back testing, then you can think about paper trading. Now, paper trading to me is good, but only up to a certain point. And it's something that you have to think about, because a lot of people do paper trading and think they're ready to go paper trading results can be very misleading, and you can misinterpret the entry and exit prices due to the slippage that the market really has. It's much better, in my opinion, to trade with real money, but my suggestion is to start out really small. A lot of people just create these models and they go for it. They start trading huge amounts of money. Start off with small dollar sizes or small contract sizes and just test your model and see how it's going. See what kind of slippage you're getting. You need to start off slowly, and then if things are working well for you, then start expanding the size of the contracts that you're trading or putting more dollars into it. Trading with real money teaches you a lot more than paper trading. So even if it's small, you still feel more attached to it. You care more because there's real money. It'll help you really focus in on what your personality's like and what you are like. You'll pick up a lot more information trading with money rather than paper trading. Okay, let's talk about drawdowns. The thing about drawdowns is that you want to analyze every single drawdown from your models in all kinds of time periods that they occurred in. All trading models have drawdowns. Don't fool yourself. Every model out there will have drawdown periods. You have to understand the questions that you're asking yourself and what are the drawdowns like. For example, what's the longest drawdown? What's the shortest drawdown? How deep did it go? How long did it take to come out of that drawdown? These are the kinds of questions you should be asking yourself about drawdowns. Let's go on with what is a trading system. A trading system can be just one trading model, or it can be a combination of models. In my opinion, it's important to understand if there are different models in the trading system, then you have to understand the whole picture together. You have to understand all the models together, how they work together. Once you have all the models, if there's different models operating, you have to understand how the returns are correlated. Correlation is a really double-edged kind of sword. It really depends, and correlation is one of those things that you have to treat it very carefully. A lot of people think, they make money for a while with the correlations that they have, and then all of a sudden when panic occurs and the markets go haywire, well, usually correlations go haywire, and that's where a lot of people lose a lot of money. Hedging. Hedging is also a double-edged sword. It's great to protect your losses, and hedge those losses, but it also will take away from the upside. Nonetheless, it's still preferable to have models that hedge each other. When you're trading a variety of models, you're going to be more hedged according to how the market's changing. So I prefer to have different models rather than just one model. Money management. I don't care how good your models are. You will fail without a disciplined approach to money management in trading. You must have a money management system that goes along with the models that you're trading. Understanding how to position size on every trade is very important. You should approach trading with a disciplined money management system, and you got to understand that the money management system is a system. It's a system like your trading models are. The things have to be complementary to each other. Without it, you're going to fail. We're tradingxyz.com. We provide real-time buy and sell signals to institutional and retail clients. I thank you for listening to me today. I hope this has been helpful to you, and thank you from the tradingxyz.com team.